of Morgan Stanley Investment Management. Andrew, just to kind of tag on to what Dom was showing us there, it's interesting because the so-called catch-up trade, as we were describing, that 200 basis point differential between the equal weighted and the S&P 500, to me, that's happening largely during a period where you don't have much in the way of fundamental news. It's after a lot of the earnings reports have come out. You've got obviously a lot of reaction to a potential pivot by the Fed. What does that indicate to you as we look into 2024, when we should get some more idiosyncratic information, some earnings reports, some fundamental news? What does that tell you about just kind of the trend and the broadening out that we've seen this year?
Sure. Well, look, first of all, Leslie, I think you have to remember that, unfortunately, the first year off a bear market low, investors sell stocks. It happens all the time. We saw net outflows from equity, mutual funds, and ETFs for a year off the COVID low, and we saw it again this go round. And it's about 1 year later, investors flipped from being bearish to bullish. It happened in February of 2021, and it happened in November of this year. And when they go to buy, when they realize they shouldn't have been selling, they should have been buying, they look around for things that they feel that they could play catch up. So it is entirely logical that the equal weighted S&P has played catch up to the cap weighted because it was really lagging. And so as I move into next year, the breadth of the market, and so what Dom talks about, so many stocks are working now. If you look at history, it is an extraordinarily bullish signal for the market. You have to have your head in the sand to really be bearish at this juncture. It means the market is breaking to the upside. As Contessa said, we're near that 47.96. I think when we break through that level, you're going to see an even higher level bullishness. Keep in mind, the market has gone nowhere for 2 years, and that's about to flip. So I think it's a bullish sign for the markets going into next year. My only comment, I'm always interested in what people do not expect. I hear everyone talking about how equal weighted will outperform the cap weighted. That seems to be an overwhelmingly consensus view next year. And so I'm intrigued by, well, what if these big stocks, they have not kept up, obviously, as Don's pointed out, they have not kept up with the broader market. And so they look like they've stalled out recently. So new money, I think new money coming in might want to flip and say, well, maybe these stocks will play catch up. Yes, they've done better year to date, but they've kind of lagged recently.
Interesting. Well, you've got, what is it, $1.4 trillion that went into cash this year. Obviously, cash was an attractive asset. Bonds did pretty well if you're a bond investor. And I know you believed that investors were underweight equities going into Q4. Do you believe they are still underweight equities, especially as you look at the various attractiveness of the other asset classes out there?
Sure. The hottest product this year was the money market. And my experience is whatever is the hottest product usually doesn't do well the next year. So if rates come down because the economy is slowing down, that will make the money market not as attractive as it was this year when rates were higher. Some of that money will come out and it will go into bond funds, and some of it will go into equities. Look, at the end of the day, we've just seen fund flows turn positive on a weekly basis. It doesn't stop after 3 weeks of positive flows. I think that money will come back into equities, and that will push the second year of a rally as it did in 2021. Doesn't mean that the market looks a little bit short-term overbought, but I think it's a good sign for equities for next year.
How much does investor psychology play a role, especially as you kind of turn that calendar year over into the new year? You've got, obviously, 2023, really the Magnificent Seven kind of catapulted into the consciousness of your average investor. Do you think because the returns were so strong throughout the course of 2023 that could be maybe a hindrance to performance next year, just based on psychology factors alone?
Well, first of all, I love that you bring up psychology, because I think it's incredibly difficult to predict GDP, earnings. Look at all the people predicted a recession this year. Earnings were going to collapse. Boy, oh boy, was that dead on wrong. But what was so consistent is just what you mentioned, psychology, which is unfortunately, investors cumulatively get bearish after a bear market. And we came into this year with overwhelmingly negative consensus. And so it's entirely consistent with what we've seen in the past. We are moving slowly from the fear stage to the greed stage. And I don't think 1 year is enough. I think it will continue. That is the consistency of investing. As I said before, I think predicting economic data is very, very difficult. And all you have to look at is what was the average price target for this year to know that that's a fool's game. So yeah. I think the psychology is we are in the process of moving from fear to greed, but we're really only very early in the stages. I think next year is the continuation of 2023.